Good morning, ladies and gentlemen. Welcome to the show on this Monday, the 23rd of August, 2021. Thank you for tuning in. Got a good show for you guys. We're going to have the pets at the end of the show, so stay tuned. Here's the thing. What's going to happen to the price of gold if we have a market crash? Because this is important to know. And, silver, too. I mean, when I say gold, I mean gold and silver. What's going to be, what are they going to do? And what's Bitcoin and crypto's going to do? In my opinion. What's going to happen is they're all going to go down if we get a crash in equities and then a crash in the markets and a bearish period that comes along out of nowhere. Okay? But there is a difference with gold and silver. If the market crash widens and deepens and a lot of fear comes in, and this could very well happen, then we'll see a sudden rush into these as a safety haven asset as the market crash deepens. That's what we'll see. And in fact, it's that point in the markets. If the markets go down like that, there's a very strong possibility they will. There's going to be a point where the Fed reacts. Because these markets are not going to know where to quit. They're not going to know when to stop. They'll gain momentum on their fall. Because there is no bottom right now. There's been so much money creation out there. And, somewhere around between probably 25% down in the markets and 40% down, the system would completely destabilize. And we could get an actual liquidation of the system where... See, deflation is much faster than inflation. It takes a long time for bubbles to blow up. It can take months or it can even take years. But they can deflate in a matter of weeks. It's basically the old analogy of a bubble popping. It takes a long time to blow a balloon up, but it pops instantaneously. And that's the way with this. It's the same way. Deflation's very fast. So they're playing with fire right now by reducing liquidity in the system, the Fed. Now, I do understand the basics behind all of this. Is they're trying to curb inflation. But like I say, they're playing with fire because the system is so over-leveraged. All of our money is created through debt creation. And what they don't create is the money to pay the interest on the money that's loaned out. So this interest accrues. It adds up. It piles up more and more as years go by. And they have to keep creating new money or new debt to service the old debt. It's a classic Ponzi scheme, guys. And now it's got to the point where the Ponzi scheme all wants to come down, crashing down. They have one tool and one tool only. It's unlimited money creation. And in truth, they can stop deflation no matter how far deflation goes. And no matter how big it grows. They can stop it as long as the system is functioning. Because they can create unlimited money to stop it. But creating unlimited money does not fight inflation. It makes it worse. It's like throwing rocket fuel on inflation. And so we're going through these little cycles. They're like market cycles, crash and boom cycles. But they're created by the Fed. And it's all got everything to do with what the Fed's doing. And this is why they watch the Fed so carefully now. They listen to every little word the Fed says. The markets do. Let's move on. Let's get in there and take a look at the markets today. Let's open up the charts right here. Take a look at what's going on. We're going to take a look at the gold and silver price first. And we're looking at the silver price today. It's up 56 cents at $23.58. It was hovering down around $22.90 and $23 there. But now it's going back up a little bit again. Let's take a look at gold. Gold's at $18.03. It's up $22.50 on the day so far. Now let's take a look at cryptocurrencies. we're looking at 2161 billion. So that's quite a big leap upwards in price from where it was. We're looking at a Bitcoin price of 49,856 right now, so it's hovering around $50,000. Bitcoin's in a bull market, no duh. There it is, going. It's in a bull market. But here's the thing: we got a system that's heading toward disinflationary. Is beginning. It's just beginning a disinflationary period. It means inflation is slowing down rather rapidly right at this point, you know. And so this is why I'm predicting a crash in the next 6 months if they don't do something to stop this process that's happening. And I don't see them doing anything. The Fed only reacts to a crisis. And so I don't see them doing anything. I see the money draining out, liquidity draining out of the system. They haven't fixed the debt ceiling problem yet. And so the whole government of the United States is paying for everything out of the Treasury General account. It's going to get tighter and tighter until they get the debt ceiling fixed and until they stop withdrawing liquidity out of the system, trillions of dollars into the reverse repo, until they reverse that and go to the repo window and start to inject some liquidity back into the system, you know, and then they'll come out with some more stimulus packages, and now they're talking about tapering, reducing their bond purchasing from 120 billion down to what? I don't know, tapering to zero. That ain't gonna fly. They're gonna have a crash. I guess the crash is the only way to spur them into action on the other side to start printing again. So, but Bitcoin and the cryptocurrencies are extremely vulnerable to this. So buyer beware, you know. You might be able to get it at a cheaper price if you were to wait until the crash is in the crash, you know, and cryptocurrency prices going down. You might be able to get it at a bargain price because it is going to go up on the other side when they start printing again. Cryptos will go way up. You know, the more they print, the higher they go, and it's always a delayed reaction. It's always on the other side of the big print. So see, we're on the other side of the big print right now. They're kind of like ocean waves, you know. They print all the money, and it takes time for it to filter down into the system. But then after they quit printing, it's a delayed effect, you see. And then you get toward the latter stages of it, and when things start to fall, that's a delayed effect too. So the tightness that's starting to happen right now, we're going to feel it in a month or two, even more than we're feeling it now. And when they start to print, it's the same thing. It's like a delayed reaction in the system. Let's take a look now at the stock market, and we're up 267 points in the day at 35,387. So the stock market's going up today still, but it's basically leveled off, really, because it doesn't really seem to want to make it up into the 36,000, 37, and 38,000 range. That's because the money's leveling off. It's all about the money. You get the money from the Feds. The Fed's everything in this. Now, watch what the Fed's doing, and watch what they're speaking. Right now, they're speaking tightness. And they're not producing any significant amounts of new money into the system, and they're talking about cutting back on what they are doing. So watch with the Fed, and then a month or two later, you see the results of Fed speak in the markets and things. You know, we're gonna have to wait through this tight period that's coming up in the next little while. But you know, I mean, some people out there are betting on the tightness, you know, and betting a lot, betting big, that the interest rates are going to go up. because of the inflationary period we've just had. I wouldn't bet on that because they can't let them go up. Let's take a look now at crude oil. 65.30. It's up $3.15 on the day so far, and still climbing. Let's see. It was up into the 70s, remember. So we did have it come back down a little bit, but now it's on its way back up towards 70 again. Let's take a look now at the MOVE index, and we're seeing a MOVE index has been slowly declining, but it's at 59.95 today. Take a look at bonds and rates, and we're seeing a mixed bag today. We're looking at the long end up, the middle down just a little bit. From the 1 year to the 3, from the 1 year to the 2, from the 6 months to the 2 year, it's up a little bit. We're looking at a 10-year at 1.26, and we're looking at a U.S. 30-year at 1.88. You know, this should be extremely bullish for gold when you get a U.S. 10-year under 1.3. That's the mark for gold. Anything under 1.3 on a U.S. 10-year should be very bullish for gold because they're not making any yields to move into Treasury bonds. And I know that they say gold doesn't make a yield. Gold doesn't yield. But the thing about it is when you get the gold price starts to move up, what is that? If it's moving up against everything else, if the gold price was surging, that is a yield. You know, they say gold is money. It doesn't have any yield. Yeah, I tend to disagree with that because if the gold price suddenly starts to move up very rapidly, that is a yield. It just means that it's not a set yield, kind of like a U.S. Treasury. You know, you got a set yield right now at 1.26%. You know, here's another thing I want to mention to you guys. Big company, one big company is the first one out there who's bought $51 million worth of real physical gold. And why that's a watershed event, why that's big, why that's important is when we're talking about large purchasers of physical product, gold and silver, you don't see that many out there, and the reason why is allocation. You see, the big money is out there in the system. We're talking nowadays in billions, not in millions. Millions is like back when they used to say, oh, the guy's a millionaire, he's rich. No, you're not rich with $1 million anymore. People are not rich with $1 million. Now it's in billions and in trillions. You know, it used to be, we used to talk in millions and in billions. Now we talk in trillions and billions and trillions. You know, so things have changed. This is a big deal, this purchase of gold. And why it's a big deal is allocation. To purchase real physical metal, you have to have some place to put it and stuff. And when we're talking about purchases in billions of dollars, which a lot of these big corporations and stuff, they got billions and billions. And they could very well purchase $1 billion worth of gold. But if they if they purchase $1 billion worth of Bitcoin, one click of a mouse, it's in their wallet, it's done. One and done, you know. But with real physical gold, you got to take possession of that gold, and then you got to have a vault or something, and you got to have trucks deliver it, and it's this big process that's very, and this thwarts an awful lot of these investors from doing it because it's just so much into it. It's kind of like a kid if he wants to do some project. I want to raise bees, Dad, you know. Dad says, well, doesn't that mean we got to get hives and we got to have live bees delivered and where are we going to put the hives and all this rigmarole that goes along with it? Well, it's the same way if you're going to purchase real physical metal. You got all this rigmarole. Well, people will steal it, and where are we going to put it, and who's going to store it for us? And the list goes on and on and on. And this is what's prevented an awful lot of big money from coming into real physical gold. They'd rather purchase just GLD. It's much more simple that way. Just click a mouse. It's kind of like buying Bitcoin. You got it, and it's done. One and done. where it's an awful lot of work involved to actually purchase a real physical metal. But we got one company that's doing it now. And is that work really worth the effort? They're doing it because they're frightened that the system's going to start to roll over, and they want to have a gold allocation connected to their company. Other companies might start following suit, and this is a watershed and a breakthrough, because as the first guy does it, and then other companies look and say, well, we should have something secure in our company too, you know, some real physical metal, something physical in the real world, because this system might come down, you know, and it might become fashionable again to have a real gold allocation. So we're going to have to wait and see, but it's the danger factor out there. Basically what I'm trying to say is the danger factor out there is raising so high, and these companies are getting so frightened that they're willing to go through that process of having to allocate the gold and have to have a storage company and all of this kind of stuff. They're starting to become willing to go through that process because the fear side is pushing them. The fear that the system could start to collapse, and they're just like we are. I mean, they want to have something real and tangible that they can hang on to. If the system, if all this fugazi starts to just go poof, poof, poof into the atmosphere, they want to have something real that they can have behind their company, as well as the regular personal finance. They want to have company finance, you know, something that's real and tangible, that they can say, hey, you know, it's got no counterparty risk. Anyway, let's move on here. Where were we? We're at bonds, and now we're going to move on to the U.S. dollar index, which is at 93.11 and falling. It's been falling all day today, but not falling real fast. But this is part of the reason why we're seeing a boost in other things, you know, is the dollar falling today. Okay, that's it for today. Now, stay tuned for the pets, guys. And bye-bye, and have a great day. Hello, guys. Here's the pets. I decided to do 4 today. The first pet we're going to take a look at is Christina, and she has sent in her pet, Lola. And we have 2 attachments here of Lola. The first one, look at the pretty blue eyes she has. Awful cute, you know. And so now let's move on to the next one. And the next pet we're looking at is Paul. Paul has sent us in his picture of, he says, I love your YouTube channel and appreciate all the hard work you put in your shows. I've been a fan since January 2020. So, a long time. Haven't missed a single show. I got he says he's converting his van into a camper. And here's the pictures of the pets. Now, the first pet here is a 6-year-old male tabby with fuzzy feet. He's very lazy and loves to sleep. He's really friendly and loves to be scratched. And his name is JJ. So here's JJ. Now the next pet this is JJ's sister. Her name is Lulu Bird. She's frisky, loves to jump on counters, and drink water from the faucet. And she keeps him on his toes. She keeps her master on his toes. Okay, so now we're going to move on to the next pets. And the next pet is sent in by Peter, and this is a picture of Godzilla. It says he calls him Bill. Bill the Godzilla. Okay, now let's move on to the next one. And the next one comes from Ryan. And it says, thank you for your show. I watch it every day. And he says, you're making us all smarter and a little bit scared. Ryan, and this is Cloudy. And his AKA Bunny Bun of Destruction. This is his Bunny Bun of Destruction. He's a little gray fuzzy pile of destruction, I guess. Remember the episode from Monty Python, you know, always, that's what it suddenly made me think of. They had this little white bunny rabbit, you know, and they were all trying to get into the cave, you know. And the bunny rabbit was guarding the door of the cave, so they all tried to rush the bunny. It was an episode of Monty Python. Anyway, thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.